Why do some individuals become exceptionally wealthy while others, who are just as intelligent, do not? Is the true path to affluence built on relentless effort, or does it depend on entirely different factors? I am 99 years old, and I have faced numerous uncomfortable questions during my life. However, there is one particular question that caused a whole room of investors to erupt in laughter, and it continues to trouble me even now. This incident occurred at the 2019 Daily Journal annual meeting when an audience member rose and asked Charlie, in spite of being partners for so long, "Why is Warren so much richer than you?" The room burst into laughter. At that time, Warren's worth was $82 billion. My worth was $1.6 billion. Do the calculation. That is 50 times wealthier. 50 times. And I understand precisely why. Before I share the true story behind that wealth disparity, I need you to perform an action for me. Leave a comment immediately with your city and your greatest financial fear. Just 2 items: your location and what concerning money keeps you awake at night. I review every single comment, and I assure you that you will grasp why this is important by the end of this discussion. And in return, here is the promise I need from you. Promise me that you will watch this entire presentation, not because I require the watch time, but because individuals who maintain wealth complete what they begin. That is the initial lesson. If you are unable to dedicate 40 minutes to understanding something that required 70 years for me to comprehend, then you are not prepared to accumulate genuine wealth. Have faith in yourself. You are present for a reason. Now, allow me to share what I told that room filled with investors when they inquired why Warren is so much richer than me. I chuckled and replied, "Well, he got an earlier start. He's probably a little smarter. He works harder. There are not a lot of reasons." Then I followed up with, "Why was Albert Einstein poorer than I was?" The room laughed once more, but I was not joking entirely. The reality of wealth is not what the majority of people believe it is. You see, I have dedicated the last 70 years to examining why some individuals acquire riches while others do not. And what I have discovered will likely surprise you. It is not related to intelligence. Einstein was a genius, yet he passed away with a net worth equivalent to about $1 million in contemporary money. It is not related to working diligently. I am acquainted with many people who work 80-hour weeks and struggle to cover their expenses. And it is certainly not related to luck. Despite what is said about Warren and me, the genuine explanation for why Warren is so much wealthier than me boils down to 3 factors that most people never discuss. 3 decisions that build upon each other over decades. 3 principles that distinguish the affluent from everyone else. And by the time I conclude this story, you will comprehend not only why Warren possesses 50 times more money than I do, but more significantly, how you can implement these same principles in your own life. Let me begin with the first reason. Warren got an earlier start. Now, most people hear this and assume, well, that is self-evident. He started investing at a younger age. But that is not my meaning. When I state that Warren got an earlier start, I am referring to something far more fundamental. Warren comprehended the power of compound interest before most people were even aware of its existence. I met Warren in 1959. I was 35 years old. He was 29. I had already accumulated my first $1 million through real estate development, and I considered myself quite intelligent. Warren, conversely, was managing a modest investment partnership from Omaha, Nebraska. At that juncture, I recall thinking, this kid is impressive, but he's just picking stocks. I was building shopping centers and apartment complexes. I was creating tangible value, or so I believed. But Warren had already grasped something that I had not: the distinction between linear wealth and exponential wealth. My real estate ventures were earning me substantial money, but they were fundamentally linear. I would develop a property, sell it, realize a profit, and then begin anew. Each transaction was distinct from the previous one. Warren, in the meantime, was acquiring portions of businesses and allowing them to compound over time. He was not simply earning money. He was engineering a wealth-generating mechanism that operated while he was asleep. The most powerful force in the universe is compound interest. This saying is often credited to Einstein, but whether he said it or not is irrelevant. Warren understood it at 29. I did not fully comprehend it until I was well into my 40s. Here is a distinct example that will illustrate my point. In 1962, Warren commenced purchasing Berkshire Hathaway stock at approximately $8 per share. It was a failing textile company. But Warren perceived something that others missed. By 1965, he had control of the company. Today, those identical shares are valued at over $500,000 each. That is not an error. $500,000 per share. The stock has compounded at roughly 20% annually for nearly 60 years. In 1996, I possessed 18,829 shares of Berkshire Hathaway Class A stock. At current values, that holding would be worth over $10 billion. $10 billion. If I had merely retained those shares and done nothing further, my worth would exceed $10 billion today. Instead, my worth is approximately $2.5 billion. The discrepancy? I donated most of those shares to charity over the intervening years. Now, before you assume I am lamenting charitable contributions, allow me to be precise. I do not feel remorse about those donations. They supported causes I held dear, and the money accomplished a great deal of good in the world. But from a strict wealth accumulation standpoint, those donations constitute the most significant single difference between Warren's net worth and my own. Warren has also consistently donated vast sums to charity, but he has approached it differently. He has retained the majority of his Berkshire shares and donated appreciated stock in other companies or pledged to distribute his wealth upon his death. This highlights a critical principle that most people fail to grasp. The timing of when you give away wealth matters enormously for your final net worth. If I had postponed making those donations until my Berkshire shares had appreciated completely, I could have contributed the same dollar amounts to charity while retaining a much larger personal fortune. But I was thinking in linear terms instead of exponential ones. Let me provide a specific illustration of this mechanism. In 2013, I stated to the Omaha World Herald, I'm deliberately taking my net worth down. My thinking is, I'm not immortal, and I won't need it where I'm going. That year, I contributed significant amounts of Berkshire stock to various causes. Those shares have continued to appreciate substantially since then. Had I retained them until the present and then donated, the charities would have received more funds and I would have preserved more wealth. It is a win-win situation I did not fully recognize at the time. What I am preparing to share next unveils the most crucial insight I gained from observing Warren build his fortune. It is something that is applicable whether you possess $10,000 or $10 million, and it represents the key to preserving wealth over the long term. But there is something even more fundamental in operation here, something that extends beyond the mere scheduling of charitable contributions. Warren and I have regarded wealth from different philosophical perspectives, and that variation has compounded over many decades. Warren has consistently viewed wealth as an instrument for generating more wealth, at least until his later years. He has reinvested almost everything back into Berkshire, enabling the company to expand and compound. I have consistently viewed wealth as something to be appreciated and distributed throughout life. Neither philosophy is inherently correct or incorrect, but they result in dramatically different outcomes concerning final net worth. Warren's philosophy maximizes the accumulation of wealth. In contrast, my philosophy balances wealth accumulation with present enjoyment and philanthropy. The arithmetic of compound interest overwhelmingly favors Warren's method. Every dollar he reinvested during the early years has compounded for decades. Every dollar I utilized or gave away ceased compounding instantly. This presents an intriguing paradox that I want you to comprehend. Occasionally, the optimal financial decision and the optimal life decision are distinct things. Warren's unwavering focus on wealth accumulation has established him as one of the richest individuals in history, but it has also entailed sacrificing other aspects along the way. He has famously resided in the same unpretentious house in Omaha for decades, operates older vehicles, and maintains a relatively simple lifestyle despite his immense wealth. I, on the other hand, have derived pleasure from spending money on things that mattered to me throughout my life. I have contributed hundreds of millions of dollars to causes that were important to me. I have lived in comfort and traveled widely. I have gained experiences and created an impact that would not have been achievable if I had merely stockpiled every cent for maximal compound growth. From a pure wealth accumulation viewpoint, these actions were errors. From a life satisfaction viewpoint, they rank among my finest decisions. This brings us to one of the most significant lessons I can offer you. You must determine which game you are participating in. Are you attempting to maximize your net worth? Are you attempting to maximize your influence on the world? Are you attempting to maximize your personal enjoyment and experiences? These all represent valid objectives, but they demand different strategies. Warren has been participating in the maximize net worth game for 70 years, and he has triumphed in that game spectacularly. I have been participating in a more balanced game, and I am content with my outcomes. In 1996, I possessed 18,829 shares of Berkshire Hathaway Class A stock. At today's valuations, that stake would be valued at over $10 billion. $10 billion. If I had merely held onto those shares and done nothing further, my worth would be more than $10 billion today. Instead, I am worth about $2.5 billion. The difference? I donated most of those shares to charity over the years. Now, before you believe I am complaining about charitable giving, let me be precise. I do not regret those donations. They went to causes I believed in, and the money achieved a great deal of good in the world. But from a strict wealth accumulation perspective, those donations constitute the single biggest difference between Warren's net worth and mine. Warren has consistently donated massive amounts to charity as well, but he has approached it differently. He has retained the majority of his Berkshire shares and donated appreciated stock in other companies or committed to distributing his wealth after his death. This illustrates a crucial principle that most people fail to understand. The timing of when you distribute wealth matters enormously for your final net worth. If I had postponed making those donations until my Berkshire shares had appreciated fully, I could have contributed the same dollar amounts to charity while retaining a much larger personal fortune. But I was thinking linearly instead of exponentially. Let me provide a specific illustration of how this works. In 2013, I stated to the Omaha World Herald, I am deliberately taking my net worth down. My thinking is, I am not immortal, and I will not need it where I'm going. That year, I contributed significant amounts of Berkshire stock to various causes. Those shares have continued to appreciate dramatically since then. Had I retained them until the present and then donated, the charities would have received more money, and I would have retained more wealth. It is a win-win scenario I did not fully recognize at the time. What I am preparing to share next unveils the most crucial insight I gained from observing Warren build his fortune. It is something that is applicable whether you possess $10,000 or $10 million. And it represents the key to preserving wealth over the long term. But there is something even more fundamental in operation here, something that extends beyond the mere scheduling of charitable contributions. Warren and I have regarded wealth from different philosophical perspectives, and that variation has compounded over many decades. Warren has consistently viewed wealth as an instrument for generating more wealth, at least until his later years. He has reinvested almost everything back into Berkshire, enabling the company to expand and compound. I have consistently viewed wealth as something to be appreciated and distributed throughout the way. Neither philosophy is inherently correct or incorrect, but they result in dramatically different outcomes concerning final net worth. Warren's philosophy maximizes the accumulation of wealth. In contrast, my philosophy balances wealth accumulation with present enjoyment and philanthropy. The arithmetic of compound interest overwhelmingly favors Warren's method. Every dollar he reinvested during the early years has compounded for decades. Every dollar I utilized or gave away ceased compounding instantly. This presents an intriguing paradox that I want you to comprehend. I would develop a property, sell it, realize a profit, and then begin anew. Each transaction was distinct from the previous one. Warren, in the meantime, was acquiring portions of businesses and allowing them to compound over time. He was not simply earning money. He was engineering a wealth-generating mechanism that operated while he was asleep. The most powerful force in the universe is compound interest. This saying is often credited to Einstein, but whether he said it or not is irrelevant. I, on the other hand, have derived pleasure from spending money on things that mattered to me throughout my life. I have contributed hundreds of millions of dollars to causes that were important to me. I have lived in comfort and traveled widely. I have gained experiences and created an impact that would not have been achievable if I had merely stockpiled every cent for maximal compound growth. From a pure wealth accumulation viewpoint, these actions were errors. From a life satisfaction viewpoint, they rank among my finest decisions. This brings us to one of the most significant lessons I can offer you. You must determine which game you are participating in. Are you attempting to maximize your net worth? Are you attempting to maximize your influence on the world? Are you attempting to maximize your personal enjoyment and experiences? These all represent valid objectives, but they demand different strategies. Before I share the true story behind that wealth disparity, I need you to perform an action for me. Leave a comment immediately with your city and your greatest financial fear. Just 2 items: your location and what concerning money keeps you awake at night. I review every single comment, and I assure you that you will grasp why this is important by the end of this discussion. And in return, here is the promise I need from you. Promise me that you will watch this entire presentation. You can engage in any of these games successfully, but you must be deliberate about which game you are engaging in. The most significant financial error I observe people making is failing to decide what they are optimizing for. Consequently, they achieve mediocre outcomes in all respects. They fail to accumulate sufficient wealth. They fail to make a sufficient impact, and they fail to appreciate the journey. Now, I want to discuss something that may astonish you. There is, in fact, a 4th reason Warren is wealthier than me, and it is one that neither of us discusses frequently. Warren is simply more adept at managing his own psychology concerning money. He is more disciplined, more patient, and more emotionally stable regarding financial decisions. This may seem like a minor point, but over decades, it results in an enormous difference. Allow me to provide an example from the 1970s. We were both observing our net worths fluctuate dramatically as the stock market navigated various crises. There were periods when our Berkshire holdings lost 30, 40, or even 50% of their value within a span of months. I recall feeling anxious, reconsidering our investment thesis, and contemplating whether we should sell some shares and diversify into different assets. Warren, meanwhile, remained completely unruffled. I remember him stating during one especially severe market downturn, "Charlie, this is precisely what we desire. We are acquiring $1 for 50 cents. If you are not enthusiastic about this, you do not comprehend the business we are in." He was not merely stating this for my reassurance. He genuinely believed it. His emotional reaction to market volatility was the inverse of most people's. When prices declined, he became excited. When prices rose, he became cautious. This psychological edge compounded over time. During every market decline, Warren was purchasing more shares at reduced prices, while others were selling in a panic. During every market expansion, he was selling overvalued positions while others were buying at the peak. This was not because he possessed superior information or advanced analytical abilities. It was because he had conditioned himself to think and react differently from the crowd. I have always been reasonably skilled at managing my emotions around money, but Warren is exceptional. He has cultivated what I term investment temperament, which is distinct from merely being intelligent or diligent. Investment temperament signifies that you can make rational decisions even when your portfolio is fluctuating wildly, even when the financial news outlets are panicking, even when your friends and family are challenging your judgment. There is a narrative that illustrates this perfectly. During the 2008 financial crisis, Berkshire's stock price plummeted from over $140,000 per share to under $70,000 per share. Warren's net worth declined by approximately half in less than 1 year. The financial media was questioning whether Berkshire would endure. Some investors were suggesting Warren should retire. I recall receiving telephone calls from anxious shareholders inquiring if we ought to alter our strategy. Warren's reaction was to pen his renowned opinion piece in the New York Times titled, "Buy American, I Am." He was not just advising others to remain composed, he was committing his resources based on his conviction. Berkshire invested billions of dollars in corporations like Goldman Sachs and General Electric during the lowest points of the crisis. These investments yielded enormous profits for Berkshire in the subsequent years. Warren's capacity to remain rational and opportunistic during the most severe financial crisis since the Great Depression illustrated the psychological advantage that has bolstered his wealth for decades. I managed the 2008 crisis effectively, but I must concede I was not as aggressively opportunistic as Warren was. I was more concentrated on safeguarding what we possessed rather than maximizing the opportunity. It's a subtle difference, but it's the difference between extraordinary returns and merely good returns. Over a lifetime of investing, these subtle differences compound into massive wealth gaps. He has retained the majority of his Berkshire shares and donated appreciated stock in other companies or committed to distributing his wealth after his death. This illustrates a crucial principle that most people fail to understand. The timing of when you distribute wealth matters enormously for your final net worth. This is the part that can change how you think about building wealth for the rest of your life. This leads me to another vital difference between Warren and me: our methods for learning and intellectual growth. Warren has consistently been more systematic about broadening his knowledge base and refining his decision-making frameworks. He consumes more reading material, learns more consistently, and implements new knowledge more effectively than anyone I have ever encountered. When I initially met Warren, he was already perusing the annual reports of hundreds of companies each year, not just glancing at them, but examining them intensively. He would read everything from major corporations to small regional businesses, searching for patterns and insights. I was more selective in my reading, concentrating on deals and opportunities that were immediately pertinent to my existing projects. Warren was constructing an extensive database of business knowledge that he could access for decades. Warren also cultivated what we refer to as mental models more systematically than I did at first. He adopted concepts from psychology, physics, biology, and other fields, and applied them to business and investing. For instance, he understood the psychological principle of social proof and how it establishes moats around specific businesses. He understood network effects by observing how systems function in nature. He understood the power of incentives by studying human behavior. I was engaging in similar cross-disciplinary thinking, but Warren was more methodical in his approach. He would deliberately seek out new mental models and practice utilizing them in investment decisions. He regarded learning as a systematic process rather than something that occurred passively. This provided him with a more extensive set of tools for evaluating opportunities and avoiding errors. There is a specific example that highlights this difference. In the 1980s, we were both learning about the concept of economic moats, sustainable competitive advantages that shield businesses from competition. I grasped the concept intellectually and could recognize apparent moats like patents or regulatory protections. Warren extended it further. He formulated a comprehensive framework for analyzing various types of moats, their strength, their potential duration, and how they could be fortified over time. This systematic method of learning and decision-making equipped Warren with superior tools for assessing investments. While I might examine a company and note that it possessed some competitive advantages, Warren could analyze precisely what those advantages entailed, how they operated, how sustainable they were, and what might jeopardize them in the future. This resulted in superior investment choices and better long-term outcomes. Warren also devised better frameworks for preventing mistakes, which is equally as important as making sound decisions. He established checklists and systematic procedures for evaluating investments that assisted him in avoiding frequent errors. He analyzed his own mistakes and the mistakes of other investors to identify patterns and implement safeguards. I was also learning from mistakes. But Warren was more systematic about converting those lessons into preventive processes. Now, allow me to share something that might be the most crucial part of this entire narrative. Why do some individuals become exceptionally wealthy, while others, who are just as intelligent, do not? Is the true path to affluence built on relentless effort, or does it depend on entirely different factors? I am 99 years old, and I have faced numerous uncomfortable questions during my life. However, there is one particular question that caused a whole room of investors to erupt in laughter, and it continues to trouble me even now. Warren's philosophy maximizes the accumulation of wealth. In contrast, my philosophy balances wealth accumulation with present enjoyment and philanthropy. The arithmetic of compound interest overwhelmingly favors Warren's method. Every dollar he reinvested during the early years has compounded for decades. Every dollar I utilized or gave away ceased compounding instantly. This presents an intriguing paradox that I want you to comprehend. If we both began with $100,000 and I earned 18% per year, while Warren earned 20% per year, after 40 years, I would possess about $750 million, while Warren would possess about $1.5 billion. That is double the wealth resulting from just a 2 percentage point annual variance. But the actual differences were likely even slighter than that in many individual years. Perhaps Warren was just marginally better at evading significant errors. Maybe he was marginally better at identifying exceptional opportunities. Maybe he was marginally better at retaining winning investments for longer. None of these advantages would be striking in any single year. But compounded over decades, they produce the kind of wealth differences we observe today. This is why I consistently tell people that accumulating wealth is not about making heroic investment decisions or discovering the next major opportunity. It is about making consistently sound decisions for very extended periods. It is about avoiding significant mistakes that can nullify years of advancement. It is about comprehending that small advantages compound into large advantages if you are sufficiently patient. Most people approach wealth accumulation backward. They search for the major windfall, the investment that will enrich them rapidly. Warren understood from the outset that wealth accumulation concerns time and consistency, not brilliance and fortune. He concentrated on making sound decisions that would compound over decades rather than spectacular decisions that might succeed in the short term. There is another dimension to this that people fail to appreciate. Warren has been engaging in the wealth accumulation game for a longer duration than almost anyone else in history. He commenced serious investing in his 20s, and he is still actively managing funds in his 90s. That amounts to 70 years of compounding. Most people invest seriously for 30 or 40 years at the maximum. Warren has had nearly twice as long for his money to compound. and the later years of compounding are the most powerful. Let me provide a specific illustration of how this operates. Berkshire Hathaway's stock price has appreciated by about 20% per year on average since Warren assumed control in 1965. But examine the absolute dollar increases year by year. In the initial years, a 20% increase might have signified the stock rising from $10 to $12 per share, a $2 increase. Today, a 20% increase signifies the stock rising from $500,000 to $600,000 per share, a $100,000 increase. The percentage remains the same, but the absolute dollar impact is 50,000 times greater. This is the enchantment of compound interest that most people never witness because they do not invest for a sufficient duration or with sufficient consistency. Warren has witnessed this enchantment for 7 decades. Berkshire invested billions of dollars in corporations like Goldman Sachs and General Electric during the lowest points of the crisis. These investments yielded enormous profits for Berkshire in the subsequent years. Warren's capacity to remain rational and opportunistic during the most severe financial crisis since the Great Depression illustrated the psychological advantage that has bolstered his wealth for decades. So, what does all of this imply for you? How can you implement these lessons in your own financial life? Allow me to offer 5 specific principles that I have learned from observing Warren accumulate his fortune and from contemplating my own financial decisions over the past 70 years. First, begin as early as feasible, but do not allow a delayed start to deter you. Warren's early commencement was vital to his wealth accumulation. But that does not imply you cannot accumulate significant wealth if you are beginning later in life. The crucial point is understanding that every year you postpone starting is a year of potential compounding that you are relinquishing. If you are 30 and believe you are too old to begin investing seriously, recall that you potentially have 40 or 50 years of compounding ahead of you. That is ample time to accumulate substantial wealth if you are disciplined and consistent. The arithmetic is straightforward but potent. If you invest $10,000 per year beginning at age 30 and achieve a 10% annual return, you will have approximately $4.5 million by age 70. If you delay until age 40 to begin, you will have approximately $1.7 million by age 70. If you delay until age 50, you will have about $630,000 by age 70. The 10-year delay from 30 to 40 cost you $2.8 million. The delay from 40 to 50 cost you another $1.1 million. Time is the most valuable asset in wealth accumulation, and you cannot reclaim it once it has passed. Second, concentrate on not losing money rather than on achieving spectacular gains. Warren's renowned rule is, rule number 1, do not lose money. Rule number 2, do not forget rule number 1. This is not merely clever phrasing. It is a profound mathematical reality. If you lose 50% of your money, you must gain 100% just to return to your starting point. If you lose 90% of your money, you must gain 900% to return to your starting point. Significant losses can nullify years or even decades of progress. This implies being extremely cautious about speculative investments. The actual secret to Warren's exceptional wealth is not any individual decision or advantage. It is the compounding influence of minor advantages over extremely long durations. Warren is wealthier than me not because he executed 1 or 2 masterful moves, but because he made marginally better decisions consistently for 70 years. Consider it in this manner. Most of the money in investing is generated by doing the opposite of what feels intuitive. When markets are declining and everyone is panicking, that is frequently the optimal time to buy. When markets are soaring and everyone is euphoric, that is frequently the optimal time to be cautious. This necessitates developing an emotional discipline that most people never attain. You can cultivate this temperament by studying market history, comprehending that volatility is normal and transient, and concentrating on the long-term fundamentals of your investments rather than short-term price fluctuations. It also helps to have a systematic investment process that removes emotions from the equation as much as possible. Regular contributions to low-cost index funds, for instance, compel you to buy when prices are low and continue buying when prices are high, which averages out to favorable long-term results. Fourth, be extraordinarily selective about your investments, but when you discover something exceptional, invest substantially. Warren's 20-hole punch card concept is applicable to everyone, not just professional investors. I have witnessed it for about 5 decades. That 20-year difference in compounding duration explains a substantial portion of our wealth disparity. What I am about to share with you is the most practical advice from this entire narrative. These are the specific lessons you can implement immediately, irrespective of your current financial circumstances. It means conducting your research, identifying a few excellent investment opportunities, and allocating meaningful amounts of money to them rather than scattering small amounts across dozens of investments. For most people, this might mean selecting 2 or 3 low-cost index funds that span different asset classes and investing consistently in those rather than perpetually pursuing new investment ideas. Fifth, comprehend the distinction between accumulating wealth and preserving wealth, and be deliberate about which phase you are in. In the wealth-building phase, you aim to maximize growth and compound returns, even if that entails accepting some risk, perhaps living below your means. In the wealth preservation phase, you aim to protect what you have accumulated and generate income from your assets. The essential part is recognizing when you shift from one phase to the other and modifying your strategy accordingly. Warren has remained in wealth-building mode for his entire career, which has maximized his net worth, but demanded significant sacrifices regarding current consumption. I shifted to more of a balanced approach earlier in my life, which diminished my ultimate net worth, but permitted me to enjoy my wealth and create an impact through philanthropy along the way. As I contemplate this question of why Warren is so much richer than me, I recognize that the answer unveils something significant about success in general. Warren did not become extraordinarily wealthy because he is extraordinarily different from other successful people. He became extraordinarily wealthy because he is slightly better than other successful people at a few crucial things, and he has sustained those slight advantages for an extraordinarily long time. This holds true in most spheres of life, not just wealth accumulation. The best athletes are not dramatically more talented than other professional athletes. They are slightly more talented, slightly more disciplined, and they maintain those advantages for slightly longer careers. The most successful businesses are not dramatically different from other successful businesses. They are slightly better at a few key functions, like customer service or operational efficiency, and they maintain those advantages over time. The lesson for all of us is that extraordinary results stem from the compounding effect of small advantages maintained over extended periods. You do not need to be dramatically more intelligent, more talented, or luckier than everyone else. You need to be slightly better at a few important things and maintain those advantages consistently over time. This concept of maintaining slight advantages consistently is, in my opinion, intrinsically linked to another critical and often overlooked factor: the environment you create for yourself. I am referring specifically to the people with whom you associate. My own journey was immeasurably shaped by my partnership with Warren. It is not merely that 2 heads are better than one. It is that 2 rational heads, constantly checking each other, are exponentially better. We both understood that the single greatest enemy to long-term success is not a bad market or a poor economy. It is our own human psychology. We are all susceptible to envy, greed, fear, and the desire to follow the crowd. A trusted partner who shares your fundamental values and long-term outlook acts as a crucial barrier against that emotional folly. Many times over the last 7 decades, one of us would bring an idea to the other, and the listener's simple question, "Are we truly thinking this through, or are we just excited?" was enough to prevent a costly error. This is not a small advantage, it is a foundational one. This partnership also reinforced what I consider to be our most potent yet simple operational principle, the avoidance of stupidity rather than the pursuit of brilliance. Most of the world is busy trying to be clever. They are looking for the next complex algorithm, the next undiscovered market, the next intricate financial instrument that promises high returns with no risk. We took the opposite approach. We decided very early on that it is much easier to avoid obvious pitfalls than it is to achieve strokes of genius. We focused on what not to do. We made a conscious effort to stay away from businesses we could not understand, no matter how appealing they seemed. We avoided excessive leverage, which can turn a temporary setback into a permanent catastrophe. We avoided associating with people of questionable character, knowing that poor ethics inevitably lead to poor outcomes. This process crystallized into what we call the too hard pile. When a new investment opportunity comes across our desk, the first question is not, how much can we make? The first question is, can we understand this? Does it fall within our circle of competence? This circle is not defined by its size, but by the clarity of its boundaries. We know what we know, and more importantly, we are acutely aware of what we do not know. If an industry like technology in its early days or complex derivatives requires forecasting distant futures or understanding Byzantine structures, it goes directly into the too hard pile. We do not feel shame in this, we feel prudent. We are not paid to have an opinion on everything. We are paid to make a few high-quality decisions over a long period. By ruthlessly discarding the vast majority of opportunities as being too difficult, too uncertain, or simply outside our expertise, we conserved our mental energy and our capital for the truly exceptional, comprehensible ideas that came our way, perhaps only one or two in a given year. This discipline of saying no is a slight edge. This avoidance of unforced errors is a slight edge. And, as I have said, these are the only things that matter when compounded over a lifetime. There is one additional lesson I want to share with you, and it's perhaps the most critical one. The question of why Warren is richer than me presumes that being richer is inherently better. That is not necessarily accurate. Wealth is an instrument, not an objective in itself. The question you should pose to yourself is not, how can I accumulate the most money possible, but rather, how much money do I require to live the life I want and make the impact I wish to make? Warren has opted to maximize wealth accumulation, and he has been extraordinarily successful at that goal. But that decision has necessitated trade-offs. He has lived modestly, worked perpetually, and postponed most of his consumption and philanthropy until late in life. I selected a more balanced approach, appreciating some of my wealth along the way and contributing significant amounts to charity while I could observe the impact. Both approaches are valid, but they require different strategies and lead to different outcomes. The key is being intentional about your choice. If your objective is to maximize your net worth, then study Warren's approach meticulously and be prepared to make the sacrifices that extraordinary wealth accumulation demands. If your objective is to balance wealth accumulation with current enjoyment and philanthropy, then comprehend that you are optimizing for something other than maximum wealth, and be content with the trade-offs that choice entails. But whatever you select, do not let the perfect be the enemy of the good. You don't need to be Warren Buffett to build substantial wealth and financial security. You don't need to earn 20% annual returns or become a billionaire to live comfortably and achieve your financial goals. Focus on making consistently good decisions with your money. Avoid big mistakes and let time do most of the work for you. As I approach the conclusion of this story, I want to address something that might be on your mind. You might be contemplating, "That's all well and good, Charlie, but you are discussing decades of investing and compound growth. What if I do not have decades? What if I'm already in my 50s or 60s and haven't built significant wealth yet? First, recall that even 10 or 15 years of disciplined investing can make a substantial difference in your financial situation. The principles I've discussed, avoiding big losses, making selective investments, thinking long-term, are effective over any time horizon. They simply are more effective over longer time horizons. Second, understand that wealth accumulation is not solely about investment returns. It's also about managing your expenses, maximizing your earning potential, and being tax efficient with your money. If you're beginning later in life, you might need to be more proactive about these other facets of wealth accumulation to offset the shorter time horizon. Third, consider that your wealth accumulation phase might extend longer than you anticipate. People are living longer and maintaining health later in life than previous generations. You might have 20 or 30 years of potential investment growth remaining. Even if you're beginning in your 50s or 60s, that's still ample time for compound growth to exert its influence. Finally, remember that the objective is not to become as wealthy as possible. It's to become sufficiently wealthy to meet your goals and live the life you desire. You might not need as much money as you believe you do, especially if you're thoughtful about your expenses and realistic about your goals. Accumulating substantial wealth is attainable at any age if you're disciplined and consistent about it. Now, let me bring this story full circle. When that investor inquired why Warren is so much richer than me, I offered a brief, humorous response because it was a public forum, and the complete explanation would have required hours. With the right principles, the right mindset, and enough time, the answer to that question is almost certainly yes. And if someone asks you in 30 years why some other investor is richer than you, I hope you'll be able to give them an answer that shows you made intentional choices about what you were optimizing for in your financial life. Because ultimately, that's all that distinguishes successful investors from everyone else. These advantages were minor in any single year, but they compounded over 7 decades into an enormous wealth gap. The good news is that you can apply these same principles in your own financial life. You can begin investing systematically, concentrate on avoiding significant losses, cultivate the temperament to think long-term, be selective about your investments, and maintain consistency over time. You can't replicate Warren's exact outcomes because you can't replicate his exact circumstances, but you can achieve substantial financial success by employing the same fundamental principles. More importantly, you can make intentional decisions about what you're optimizing for in your financial life. If you wish to maximize wealth accumulation, you can learn from Warren's approach. If you want to find some other equilibrium, you can devise your own approach based on these principles. The key is being intentional, being consistent, and being patient. Wealth building is not a get-rich-quick scheme or a game of discovering the perfect investment. It's a long-term process of making good decisions consistently over time. It's about understanding that small advantages compound into big advantages if you give them enough time to work. As I stated at the beginning of this discussion, people who stay wealthy finish what they start. If you've watched this far, you've shown the kind of persistence and focus that wealth accumulation demands. Now, apply that same persistence and focus to your financial decisions. Formulate a plan, adhere to it, and let time and compound growth perform most of the work for you. Remember, the question is not whether you can become as wealthy as Warren Buffett. The question is whether you can become wealthy enough to achieve your goals and live the life you want. With the right principles, the right mindset, and enough time, the answer to that question is almost certainly yes. And if someone asks you in 30 years why some other investor is richer than you, I hope you'll be able to give them an answer that shows you made intentional choices about what you were optimizing for in your financial life. Because ultimately, that's all that distinguishes successful investors from everyone else. Not the magnitude of their bank accounts, but the intentionality of their decisions and the consistency of their execution over time. Thank you for staying with me through this entire story.